Welcome, everyone, to the second and final video series of Schneider Allen's Wealth Management coverage of the private markets, titled Traditional to Seed and Everything in Between. Joining me is my colleague, Matt Biggs. So I think today we're going to talk, we're going to give you a high-level summary of some of the fundraising that's gone on in private markets, talk about some specific deals, and then trends that we're seeing in the market and what we think might happen in 2025. And I think I want to spend a little bit of time talking about why we think private markets are set to do well in 2025. But I think the election was important in that it provided some clarity on the direction of where private markets and then just kind of markets in general are likely going to trend with President Trump and incoming Vice President Vance coming in. They've laid out an economic agenda that they still have to execute on, but is very much kind of pro-business and pro-American business. And they're talking about focusing on lowering the barriers to M&A, creating higher economic growth, which the hope is if you get kind of that 3% GDP growth target, you're going to get more investment coming in here. But it's a bar that clearly you're starting to see some enthusiasm. And I think from that enthusiasm, a lot of it revolves around the U.S. being the dominant player in AI. And I know, Matt, you wanted to spend some time talking a little bit about that.
Yeah, and I know that this is something that you and Sean will probably touch on a little bit in the other video series, but I do think it's important to point out, look, public market's been a pretty great year. S&P as of today up 26%. We've continued to see large cap growth do well. NVIDIA is probably the best example when we talk about AI, and it's the name that most people associate with AI when we're talking publicly traded companies. And NVIDIA is up 172% year to date. I just thought it would be a good idea for us to briefly talk about what our approach is in the AI boom and specifically from a private market standpoint, Jason. And since you do the other podcast, closely focused on that, wanted to hear your thoughts on kind of what our take and what our approach is and how we are still kind of indirectly investing in AI.
Yeah, I think you have, the first leg of this innovation you saw, or kind of the market return that's realized by investors, happened in the public markets. You had NVIDIA, Microsoft has very well publicized. They went through the process of kind of converting to a for-profit entity and a lot of that. But that was the first leg of trade. The NVIDIA, the Microsoft, you're seeing a very big run-up in Broadcom over the last 2 weeks. So kind of that's the public leg that I think everybody is aware of. Like all things, there's a way to look at this holistically. And I think the first thing that comes to mind is that it takes a great deal of energy to create the environment where these large language models can come through and do all the processing that allows AI to be the powerful tool and kind of generate the promise, right, of what it could be from a energy perspective, right? I think that's what you alluded to on the real asset side. There's a clear need for an all of the above and then some approach. We are, 3 Mile Island. The infamous 3 Mile Island is getting recommissioned. They're going to try to bring that on. You're seeing Google and Microsoft try to create mini nuclear reactors to power some of their data centers. The promise of AI can only be fulfilled if we have the energy and the talent here in the United States to harness it. So there's that energy component that we're very excited about and from an infrastructure perspective. And then on the private market side, there are these businesses that you wouldn't necessarily think are in the AI supply chain, but they are the people that are creating at the lower levels, software to help implement. When you look forward and you fast forward, though, there's an opportunity. Venture capital people have pulled back allocations. The innovation hasn't stopped. Just the capital hasn't come into the asset class nearly as much as it was, kind of coming out of 2020, 2019, 2020, and 2021. And we're going to throw up a few charts here provided from our friends at JP Morgan Asset Management that show you kind of where fundraising sits and what we're excited about. But I think AI, a more holistic view of AI outside of these publicly listed stocks, there's a massive opportunity there.
2021 was kind of a historic year from not just fundraising, but also the exits and just the amount of deal volume happening. And that was because of the low interest rate environment. And I think now it's, fast forward to 24, and you can see that on this chart, year to date November, we're at about $1 trillion in global private capital fundraising versus, to your point earlier, Jason, 2021, almost 1.8 trillion. So
and the level of fundraising is kind of in between where we were in 2015 and 2016. But what we want to show here is that there's been a retracement in fundraising. So if that in and of itself is kind of a way of showing demand, but also kind of the commitments that were made. You're seeing some of this rise of private credit where maybe PNC syndicates a loan, creates a loan and then sells it into the private markets, private credit. Real estate, again, kind of as private credit has gone up, real estate, which we touch on in our sister podcast, Hard Hats, Shovels, and Lunch Pails. Private real estate fundraising has been down. I think we've touched quite a bit on that. Infrastructure has been pretty consistent. And then natural resources, you can't even see it because very few, there's not a lot of money going into that. That kind of goes back to the original comment around AI and why we're so excited for that particular opportunity set. But you look at this next chart, again, by our friends over at JP Morgan Asset Management, you can see there's a lot of dry powder by asset classes that are out there, which is, if you talk to private market participants, one of the things that they are excited about in 2025, again, is the policy, words have to become policy, right? You have to take campaign promises and make them into solutions. But this incoming administration has certainly generated a lot of confidence among CEOs when you look at those surveys, whether that's confidence about a regulatory regime, the tax regime, or just the overall economic growth picture. CEOs are very excited. I think private market participants are excited about what that could unlock. There's a lot of cash sitting on the sidelines, right? And they've come off the 2022 lows, and 23 was a great year for equities. 24 is shaping up to be, a very good year for equities. The private markets recovery has been slower, and it really won't manifest itself until you start to get the distributions coming out.
This is kind of the environment that we're in right now. What are we expecting? Do we expect that to change? What is the 2025 outlook looking like for, moving forward?
Yeah, and I think that it's like everything, it's not going to be a straight line. Right. It is, but you look at, the dry powder that's out there that's going to have to get invested. I think businesses are in a position where if they had a number in their head and they thought, hey, maybe that number gets better because interest rates are going to come down, access to debt. Well, the Fed cut 25 basis points and kind of said, hey, we might be on pause moving forward. So I think there's going to be some price certainty where you're not going to be maybe holding out hope for, for a better price to come along. If there's follow through on the policy perspective, I would expect then to see, more robust capital market activity. And I think it's a good time to be an allocator in the private markets, because you have public markets that have enjoyed a really great run, and valuations. We're not going to talk about public market valuations here. Everybody, I'm sure that's watching this has seen, talk about where the Mag 7 are trading and where the S&P 500 is and growth versus value spreads. But I still think kind of the old adage that Benjamin Graham, pioneered, which is kind of, the idea of buying a business at a good price, being able to buy low and sell high. Well, the markets are pretty expensive in the public side. They could still go up, but I think one thing that we're seeing is on the private market side is that you can buy a really good lower middle market business for 7 times. You're starting to see that kind of come in. I would say on the international side, the one thing that you haven't seen is a whole lot of deal flow there. Obviously, the prices are a little bit lower. And I think that's from a purchase price, to enterprise value to EBITDA, which is kind of the price to earnings of a ratio of the private markets. It's been pretty consistent over the last 2 years. I think 2023 was right around maybe a little bit less than 11 times. Where we are right now is maybe a little bit more than 11 times. But I think that whether it's debt to EBITDA, EBITDA to kind of cash interest, kind of all of those metrics that are used in the private markets, things have relatively stayed the same in private markets versus that public markets that's really moved up. That's where we think that there's some real opportunity. And going to throw up another slide up here on the opportunity side, Matt, to kind of tee you up to talk about where we're seeing from an exit environment perspective what the opportunity is. And we're just going to throw up a chart here that talks about IPO deal value.
IPOs specifically, we think about public market sentiment, right? So tough to do an IPO when markets are selling off, right? That's not necessarily the best time to roll out an IPO. Q1 and Q2 relatively active. Now you go to 20 through 2022 and the end of 21, and it kind of a little bit of a spike there, right. Normalized a bit, and then now we did see activity pick up in Q1 and Q2. What I would say is the PE-backed IPOs for 2024 so far have done pretty well. Worried about kind of where taxes were going. There are all of these things that are coming in. Now, that's also to say we've got an administration that's going to come in here and potentially, talking about tariffs. And it's not a perfect scenario at all. But what we do think is that there's a reason to be excited about private markets, both from what you have in the ground, that money that's already working for you, and commitments that you may have made in 23 and 24 and in the beginning part of 25 that are, have a lot of dry powder. Kind of going back to that chart, you committed capital, but they maybe have only called 35, 40% of the fund, being very judicious in the price that they're paying. To your point earlier, private equity coming in and buying a business versus looking outside my window, PNC going and buying a business, right? You saw more sponsor-backed activity. It would be very interesting to see if that continues, or you get the corporates kind of coming back, have a little bit more confidence in it, and then all of a sudden they've got something going where you're getting more activity moving in. I think IPO volume, it shouldn't return back to where 2020 and 2021 is, but we need it to get back up, both from it's a good measure of where the sentiment is of the investors, but also getting distributions back into the pockets of limited partners. And then I think this idea of holistically investing in AI, I think that's something that we're going to be talking about in every one of these iterations moving forward. It's just that the view of there's so much investment that needs to be made across so many subgenres of this asset class, and there's going to be a lot of ways to hopefully make money for clients and to make investments in really interesting companies. But I think those are the kind of the big takeaway highlights. We look forward to seeing you all early in 2025. Take care and see you soon. Thanks, guys.